Today I'm talking about the psychology of crypto, the three things that I believe make this up, and then we'll quickly go through them and hope we get a video under 5 minutes. Let's try it. Here we go. So I'm going to go through 15 emotion kind of things that people go through when they're trying to trade and why they aren't successful in trading. And I got these from the site down below there, and it's the mindset of a successful trader. So, the first thing that holds people back is the fear of losing, the fear of being stopped out, fear of taking a loss. And it's basically, the feeling of I can't take another loss or I can't take another hit. So it's kind of like that, your ego is at stake or something like that that holds you back. The next thing is getting out of trades for no reason. A lot of people, they get in a trade and then they're like, I'm out, I can't handle this, right? So then they get out too soon. And it's also that need of needing to see that green, right? And then you might get out too early and then you watch it go and it could have doubled, right? If you had a plan and it was supposed to double and you took it out 10% up because you just had to have a green or something like that, that holds people back as well. Adding to a losing position, there's a thing where you buy down or you buy a dip or something like that, but you always have a stop loss, a chance to get out. You don't want to just keep buying and buying and buying as the coin's going to the ground, right? You buy as much as you can down to a certain point and then you get out and you take a loss because you don't want to. The worst thing you can do is bleed out. Wishing and hoping, not wanting to take control or responsibility of your trade. It's kind of goes with the inability to accept the present reality of the marketplace. It's kind of just like throwing your money in there and I just hope that's going to double or triple over the next couple of years. Compulsive trading, that's kind of your FOMO. You're drawn to the excitement of markets. That's where kind of addiction, gambling, that kind of, needing to feel like you're in the game or that you have money in there. That's one kind of emotion that a lot of people have. Feeling anger after losing a trade. Like I lose a lot of trades, but the ones I win by a lot, right? You're trying to, sometimes you feel like you're being a victim of whales or you set unrealistic expectations and then you feel angry after, right? You want to feel like you're making money like everyone else is and you're mad when other people make it and you don't, right? So you have to kind of get over that anger of losing a trade. Excessive joy after winning a trade. So like trying to say, I'm in the top 1%, only 1% of people or 10% of people are successful in trading and I made it, I'm the best, and then you kind of get that joy which kind of overtakes your trading and your emotions. And then, the next couple trades you might be good too, but then you're gonna have one really bad trade because you become too overconfident. Limiting profits, saying if you're coming from the stock market kind of world, making 10% and I'm done. Like you're saying that you don't really deserve to make that extra, 20, 30, 40%. Usually it's kind of a psychological barrier. I'm in and I'm out and I've made my profits and I'm done. And that kind of, limits your profits. And then you can't really be successful if you can't keep limiting your successful coins and you take some losses. You need to let those successful coins run for a bit more. Not following your proven trading system or your plan. You think it works, you tested it, you might not have, the one time you're like, screw it, I'm just going to do something else or do what somebody else says. Once you have a trading system or a plan, just stick to it, right? You don't need to, second guess your trade, and that goes to the next one, overthinking the trade, second guessing it, getting influenced by other people, not trading the correct position size. So if you're too deep into a coin, you can get wrecked overall, right? Like I keep saying, risk 1% of your total trading stack. And that doesn't mean trade with that 1%, it means that you can lose 1% and be fine. Because the ones that do win are going to win way more than the 1%. Trading too much, so that kind of goes with forcing your trades. Afraid to trade kind of goes with it. So, if you don't have a trading system in place, you're like, I don't know when to get in, when to get out. Getting irritable, after a bad or a good trading day, you throw money into a coin and you expect it to go somewhere and it just stays even, right? Ethereum I had a little bit of, and it was stuck around 300 for like 2 months, I think, last year, and you kind of just like, you want to poke it with a stick, right? And lastly, trading with money you can't afford to lose. Along with the, emotions of crypto, a lot of people pay attention to, a 24-hour change, Blockfolio, CoinMarketCap, and they see, they look at the price and like, okay, that's cool. They look over on the right and they see, the change, and they see these, and they see green and red, and that's a big, thing. Is people, when they see green, they feel like, oh, I'm either missing out, or yeah, I'm making money, or when they see red, they say, I'm losing money, or something like that, right? But it's the whole perception behind it, and I'll show it in the next few slides. You can't let the red and green take over your life. And here, I'll explain it right here. Does this look any better? We got all greens on the right? What about this one? Minus 57%, minus 51%, 24-hour change, right? I don't know if you noticed, but these prices haven't changed. None of them have. From what they were here, to the green, to all the red, none of them changed. But when you're looking at it, you feel like you lost 57%. You feel like you gained a ton. And you feel like it's going nowhere, right? And it's this kind of perception that everyone looks at and thinks, oh, today we're in the red, for Ripple. But are we? Now here, I'll show you an example here. So you have to think 24 hours behind, right? And this is why you can always call, or why I always say tomorrow's going to be a red day, just so you guys know. Because if we go up like this and we top off like this, right? This little, I guess I call this kind of a hanger. This hanger is following 24 hours behind. So we're going to see green, green, green. And we're going to still see green because this little hanger is going to be back here. Green, green, and then we're going to see, 1 or 2%. And then we're going to start seeing reds because the hanger that you're looking and comparing to is from here, right? So you're going to see a huge red, but it already happened. It happened way before you actually see the number. Same with here. You're going to see greens. I can tell you're going to see greens. As soon as we go up like this, I'm going to say we're going to see green tomorrow, but you can't, say that we're gaining a bunch of money if you look back here and we lost a bunch too, right? Here's a really kind of extreme, but it also happened. So on this chart, I have two greens right here and right here, 24 hours apart, right? From here to here, you're going to see, these numbers are backwards, you're going to see a 35%, and it's going to be green on this candle. It's going to be 35% on this candle. 15 minutes later, look at this. This right here where this red is, you're going to see this. So you're going to see the 24 hours ago from the very top of this candle. So you're going to go from a 35 green to a minus 27 red. And that's going to happen within, 15 minutes to an hour between each other. Do you see why this is seeing the green and seeing the red doesn't mean a thing? Because you're just seeing what it was at that certain time 24 hours ago, right? You're seeing the lag, and it already happened. Your portfolio already changed. It changed when it came to here, right? But you're going to see this, and it's going to look funny because you're going to be like, I'm up 35%. And then the price hasn't changed really. It's still sitting around 307. And you're going to see, oh, I'm down 27%. Well, are you? No. You haven't changed. You're still around 307. You're seeing the lag, right? So seeing green and seeing red doesn't really matter in your portfolio. You've already seen it. It's already priced in. Another big thing is the maths of crypto. So, I'm not sure how many people know this, but the market cap is made up of the price times the circulating supply, which every coin has a different circulating supply. You times those together, and that's what gives you your market cap. So you can see how the different circulating supply is going to give you, with the different price, is going to give you a different market cap. And you can kind of see that there's some that are 82 cents, some that are 1300, 9,000, 600, 147, and you can always tell if somebody knows this when they say, oh, this coin is cheap. Ripple is cheap, it's 82 cents. Bitcoin is expensive, it's 9 grand. You know if someone's not, educated in it, or the circulating supply or the price, and you try to explain it, and it doesn't really make sense, but here's the math. So if we take Ripple and we take Bitcoin, right? Because those are the ones that are most far apart. So Bitcoin right now, and we're not going to use all-time highs here, but Bitcoin right now is around 9,000. And Ripple's around 82 cents. You'll hear people saying, I'm buying Ripple because someday it might be 9,000, right? Or something like that. And you'll see how much more Ripple there is than there is BTC. And you have to think of scarcity and how much is circulating and everything. I have the calculations up here, and if we don't know, one of these, the circulating supply or market cap, we can always, move it to the other side of the equal sign and divide, right? So just to show you here, for Ripple to have the same market cap as Bitcoin, to be right beside it, you take the market cap here of Bitcoin, because we want it to be there, divide by 39, which is this, how many ripples are in the world, and Ripple has to be $3.95 to be at the exact same market cap as Bitcoin. I always get asked, well, Ripple, what if it's $9,000 like Bitcoin? I mean, Bitcoin started with, it was, pennies back in the day. Ripple's going to do the same thing. And that's when I say, no, it's not. We take the 9,000, we times it by the circulating supply, and we get this as a market cap. This is not 100, this is not 1,000, million, billion, this is trillion. That means that $356 trillion worth of Ripple is out there. 356 trillion. Bitcoin's not even at a trillion yet. Bitcoin's 154 million, or billion, sorry. You look at the market cap. The market cap is not, 1,000, million. It's 413 billion. That means that Ripple, to be $9,000, has to be 356 trillion alone, which means the market cap's even more. And just to show you that the GDP, the gross world product, is around 84 trillion. That's how much money is basically in the world. It's forecasted at 133 trillion. So you're telling me that Ripple alone is going to be worth that much compared to how much money's in the whole world? That's why it's unrealistic to think. And when people say, oh, it's cheap and it's someday going to be $9,000, I don't think it will ever be $9,000. I mean, unless we have lots of inflation here and something's going on. But I do think that a lot of coins will get to be so expensive that they might turn to infinity because nobody wants to buy them. Because that's when I think a coin's going to die, is when it turns to, so parabolic that it's just dead. And nobody's going to pay for it and it becomes useless or bogged down or that kind of thing. And then a new coin will come in, Some more math, the price and how much it moved and everything. A lot of people think, going to $9,000 Bitcoin is, super amazing. Like, nothing's ever going to touch it, and that's the most gains ever, and it's crazy, right? And I mean, it is over time, but let's just look at, this was last year in January, and you can see the prices of Bitcoin, Ethereum, Ripple, everything, right? And then I took the current price right beside. So, it was 900, now it's 9,000. These are, of course, not all-time highs. Those were in December, January. But if you look at just the percentage gains, if you had, $10,000, now you have 90,000. If you had $10,000, now you have, 800,000. That's basically how it all works, right? And you can see which ones gain the most. Ripple was very, low, and it came up to 82 cents, which from here is pretty good. 126 times what you put in. Crazy when you think people are like, oh, I want more Bitcoin, and the price is 9,000. That's crazy high. And no, it's all relative. It doesn't really matter. It's the percentage gains that matter to you. And you can see where the best gains were in the last year. Some more math, people always get caught up on the price and they think, movement of $3 or movement of, 30 cents, a penny is like nothing compared to Bitcoin that moves, $100 a day even, and it's fine. Or $700 or $1,000, and this just kind of gives you a comparison that 300, if you see $3 is 1%, right? So if a coin is flickering 297 and 303, it's nothing. It's 2%. That's all it is. You have to always think in percent. 700, you can see it's different. $7, right? It gets a little complicated when you have decimals and little numbers like this. 380, and 380, 1% is 3 pennies, I guess, 3.8 pennies. And you can see the numbers here. So you have to treat the little numbers just as important as the bigger ones, because it's all about percentages. Same with a penny. 1% is basically 1% of a penny, right? So when you see a flicker of 99 to 101, that's 2%. That's a penny. That's going from basically almost a penny to just over a penny. It's the same percentage as going up and down $7 each way, $14 difference. So you have to always think of this, and a lot of people don't realize that it kind of scales as you go, right? 300 is different than 400. Even 300 is different than 350, because then $3.5 is 1%, right? So it's always scaling. You always have to think of percents, and a lot of people mess that up. Another thing is percent down versus percent up. A lot of people, they lose 10% and they gain 10% and they think that's the same, and it's not. And you always have to think of percents because the entire crypto market is all math based on percent. It's the only thing that matters is percent. So when people bleed down a coin 50%, you have to make 100% to get back to where you were. If you keep bleeding down, and this is based on where you got into the market, if you keep bleeding down 90%, you have to make 900% to get back to where you were. And this is why I don't usually take more than a 10% loss on a trade, because you have to make up an extra 1% over it, right? So this kind of shows if you're, people always think, oh, I'm kind of flickering 20% down, 20% up every day or two. This just shows with $10,000, losing 20% and gaining 20% the next day over the course of 16 days, what it does to you, right? So you lose 20%, you gain 20%. You lose 20%, you gain 20%. You can see it's bleeding you out because that's just how it works. When you lose 20%, you have to make more to get back, right? You lose 20%, you have to make 25 to get back. This also shows what happens when you lose 50% and gain 50%. You can see in $10,000 in 16 days of losing and gaining 50% constantly, you're back down to $1,000, which is a tenth of your starting. And usually you don't have this situation where you go down and up 50%. That's pretty violent, but that's just showing you how 16 days of 50% down and up could affect your whole capital. And I just realized this says 20% and it's supposed to say 50, but we're leaving it in the video. So on to the technical analysis of crypto. People are trading every single one of these and then more. So people are always looking at trends. These are all different types of trends. Trend lines, straight line where the price is going. Support resistance lines, which are also fib lines. People are trading candlestick patterns, trading seasons. Maybe every year around Christmas, people cash out, right, for Christmas. People trade fractals and cycles. Every 3 months something happens. There's also harmonics, which are they're also kind of like chart patterns, but they're more shapes and that kind of thing. And basically you got some of these ABCDs, Gartley's, bats, butterflies, crabs, ciphers, 5-0s, and sharks. So you got people looking for these specifically. People looking for trends specifically, chart patterns, which a lot of people think technical analysis is just these, which of course it's not. And these are the most common ones that show up and fail and succeed because so many people are looking at these. I went over this in the last couple of videos. Double tops, head and shoulders, wedges, cup and handles, flags, pennants, rectangles, parallel channels, pitchforks, triangles, double tops, bombs. Yeah, that's basically your Adams, Eves. There's more. Yes, there's more. There's indicators and overlays, oscillators, volatility, volume, moving averages, your EMAs, SMAs, your bread indicators, Bill Williams indicators, Bollinger Band, RSI, your Stochel RSIs, your divergences are in here. You also got people looking at waves. There's Elliott wave, there's Neo, Sine, Wolf. I'm not sure what this Kondrativ wave is. I haven't really looked at it yet, but it was listed in there as well. Then you got complex things, which kind of fit some of these all together. We got that Ichimoku cloud and the guppy that I like trading. You got trailing stops, and then you got lots of homebrew stuff going on all the time. People are always making their own strategies, and that's when things get complex. Okay, so what is technical analysis? It's basically a guide or a set of tools to make a method and determine the best risk to reward patterns. It also assists people in trading, swing trading, day trading, trend trading. It tells you when to get in and when to get out. So what technical analysis isn't. It isn't right 100% of the time, because if it was, we'd all be rich. It doesn't predict the future. A lot of people think, oh, you're predicting the future. Well, no, I'm just predicting potential outcomes, right? I always say it's kind of like predicting the weather. You can look outside and see if it's cloudy, and based on the clouds, you can probably predict if it's going to rain or not. It might be right, it might be wrong, but if you don't use technical analysis, you're basically just inside with no windows and trying to guess if it's raining or not. And sometimes you'll be right, and sometimes not. It isn't easy, self-fulfilling, and it isn't just random lines that I just draw and then things happen, right? It's a lot of patterns and stuff that has happened in the past. You can use the past to predict the future, like the weather. It's basically this exact same thing. The weatherman's not always right. So that's basically the 3 things of psychology of crypto that I want to go through, just to show you how emotions, math, and technical analysis all come together, and that's what makes trading fun. And that's it for this video.